We now look at discussing some of the loose ends in the income statements that we have seen so far. We've already looked at the major components of revenue and expense recognition and what the major headers are that are available. We are now going to go back and turn our attention to those two or three line items that we had left earlier or we had not introduced earlier, but we will look at them now in terms of understanding what specific details those provide to us. So we're going to look at what are non-recurring items, and we are going to look at some of the other items on the income statement which are going to be of relevance to our understanding of income statements, right? Now, typically, let's first start with what do we mean by non-recurring items. Any item that is occurring as a one-off, right, which is not expected to kind of come over every years, and it's an item that is specific to this one year but probably is not going to repeat itself again and again. That is known as a non-recurring item, right? What is a recurring item? Your sales are recurring items. Expenses like salaries and marketing cost, etc., are recurring items. Non-recurring items are essentially those which are only in this year but may not repeat themselves every year, right? It is important to be able to segregate the non-recurring items since it helps us in projecting what is going to be the next year income, right? So if you have to project the sales for next year and expenses for next year and then be able to arrive at net profit for next year, it is important for us to try and find out, looking at this year numbers, as to what numbers are specific to only this year and what numbers are numbers that could continue and come over the next few years as well, right? Now, some examples of non-recurring items could be, for example, there could be a non-recurring expense on account of a penalty. Let's say there is a tax penalty, or the government just puts a penalty on a company because they violated some rule. Now, this penalty is probably going to be a one-off. It's not going to repeat itself year on year, or unless there is reason for you to believe that it is going to repeat itself year on year, we will assume that this is a one-off and a non-recurring item, right? Similarly, there could be a non-recurring income on account of an award, right? Remember, this income is also an other income, right? This income will also get clubbed in other income, but you have to note that this is non-recurring. You're not going to get award every year, year after year, year after year. In rare cases, you may, but most companies wouldn't. So if you're getting some sort of an award and a prize money for that, that's most likely non-recurring income. And you have to be careful in how you treat that because that part of the other income is not going to repeat itself year on year. Then there could be non-recurring items on account of discontinued operations, right? There could be a factory or a line of work that the company may have just discontinued, right? The company might be selling, let's say, t-shirts and trousers, and this year they've just discontinued the operations of selling t-shirts. In which case, whatever money you get from the discontinued operations in this particular year will be treated as non-recurring items because that's not going to repeat itself next year because the business itself has been discontinued, right? So practically any item that is not expected to repeat itself, right? Not expected to repeat itself is going to be clubbed as a non-recurring item. It is important for us to segregate the non-recurring items when we are analyzing a company because otherwise this might either reduce the earnings of the company if it is an expense, non-recurring one, and increase the earnings of a company if it is a income which is a non-recurring one. So we have to remove this from our analysis and then decode the data, right? Then there are some other items that we see in the financial statement. So let's take a look at this company's financial statements and we've already seen what is the revenue from operations, we've seen what is excise duty, we have seen net revenue, we've also seen other income. Now there is another concept called other operating revenue that is introduced. So you have revenue, you have other operating revenue, and you have other income. Now revenue is simple. That's revenue from the sale of goods and services or revenue from operations of the company. Other income is simple. Anything that is non-dependent or independent of the company's operations, even if the company shuts down its operations, this is going to come. So for example, interest income on the money that the company has in banks, that's other income. Regardless of whether the company continues its operations or it doesn't, this other income is going to come, right? The third field, which is the other operating revenue field, you could think of it in terms of, what do we mean by byproducts, right? So this is income that is not core to the business. So this is a non-core income, but it's dependent on operations. Dependent on operations. If the operations do not happen, this does not come in. So the classic example is a byproduct. When you produce sugar, for example, sugar companies have electricity plants, or when they produce sugar, you get something called as molasses. This molasses is used in power generation and could be sold to power plants essentially. So there is a generation of electricity that happens around this. This is other operating revenue. This is not a sugar core operating revenue, right? So any business that the company gets in lieu of running their core business, but it is not their core business, is other operating revenue. Take an example. While producing zinc, lead is a byproduct. So if the company sells lead, this production of lead is only going to happen when zinc production is happening. When you are doing zinc mining, only then will you find lead, otherwise you will not find lead, right? So it is only going to happen when it is operational, but this is not core income. It will not come if the company stops operations, but it is still not core income, and hence any such income is called as other operational income. This is typically going to be because of byproducts or because of any excess production that is happening, right? That's other operational income. Another example would be cement companies have their own power plants. Because power is a big requirement for cement, they put their own power plants. So they generate electricity for their own consumption, for their own plants usage. Now, excess electricity cannot be stored, so that is sold. That is other operating revenue for them. Their core revenue is going to be cement. Their other income is going to be any kind of interest income. Other operating revenue is going to be this sale of electricity that happens, right? So that's your other operating revenue component that comes in, right? Then we move on to the next one, which is changes in inventory of finished goods, work in progress, and stock in trade, right? Now this comes here. And if you remember, we had said these three need to get clubbed together to give you total raw material cost, right? Let's understand how. Let's say a company produces, buys raw material for 100 water bottles at the price point of 10, right? So what is the total buying? That's 1000. This is the total inventory that the company had purchased, right? Now, assume they sell 90 of these bottles at a price point of 20. So what is the sales for them? That's 1800. What is the cost for them? Now, when you're building this financial statements, and when we look at further units of our discussion, then in one of the units we're going to look at how do these financial statements get constructed. When you're constructing the financial statements, they will be generated from what bills the company has generated, right? Now the bill for the company will say this. So that's a bill or invoice that the company would have gotten when they would have bought the raw materials, right? So the bill says that you have a cost of 1000 because you've paid this money and this is an expense, right? Now we introduce once again that concept of matching principle, right? So you have to match the revenues to respective costs. Now only 1800 have come in because you have sold only 90. So you have to use the cost also for 90. You cannot use the cost for 100. But here the cost is for all these 100 that are there. So what do? You try and find out what is the change in inventory. You try and figure out what is the change in inventory. Now what would be the change in inventory? Inventory at the beginning would be 0. Let's assume it is 0 at the beginning. At the end of the year, that would be 10 bottles raw material worth rupees 10. That's the inventory. So that's 100. So the inventory has increased by 100. So you take a change in inventory and you basically subtract it. right? So you put a minus 100 here. When you put a minus 100 here, you reach the value of 900. That's your cost of goods sold. So you're combining these two, right? A negative number would mean increase in inventory. Increase inventory is going to be a negative number because then you have not sold everything. A positive number would mean a decrease in inventory, right? Let's rework this. Let's try and understand this once again. So what we are saying is that we bought 100 bottles raw material worth rupees 10 for 1000 rupees, right? Now when we sold, the sales were only 90 bottles at 20 rupees selling price, so that's 1800. The cost, however, will appear to be 1000 because the bill said 1000, right? Now you say minus change in inventory, right? So when you say change in inventory, inventory was 0 earlier and now it is 10 into 10 because 10 bottles are left at 10 rupees. You've only sold 90. That's worth 100. So you subtract this 100, combine these two, total COGS or cost of goods sold will be 900. That's the reason this line item appears here. Next year, let's say you again buy the same. So next year, you again buy the same amount, but you are able to sell not only these 100, but also the 10 that was left earlier. So your sales are 110 into 20. That's 2200. The cost still shows 1000 because your bill is still 1000, right? You have to subtract the change in inventory. Now, what is the change in inventory? 100 would become 0. So the change in inventory is minus 100. So you will do a minus of minus 100. You have to subtract the change in inventory. That becomes 1100. And 1100 matches with 2200. 900 matches with 1800. That is how you introduce or take care of the matching principle on costs versus the sales that are happening against those costs, right? So in simple terms, all we need to do is just add these two together and purchase of stock in trade as well. So add these three items together to get total raw material cost for any company, right? Total material cost for any company in the manufacturing space. In the non-manufacturing space, you will not see this line item any which ways, right? For services companies, we don't see these data points. And that's your other item in terms of change in inventory. And so the change in inventory shows if we have used items pertaining to the last period or if we have not used the items we purchased for raw materials for this period. This is to adjust the cost of raw materials according to the matching principle. Just remember this in mind, right? That's your changes to the inventory. One last item that we see is a deferred tax expense benefit, right? Now, when we look at this deferred tax, this typically comes from the perspective of let's take an example. Let's say depreciation rates for a building or a laptop, right? Now, I say that I will take a laptop worth, let's say, 10,000 rupees, and I'm going to use this over 5 years, which means in the first year, the depreciation should be only 2,000, right? The income tax department might say that that's incorrect, right? You need to put in a depreciation of 50% on electronic items. So there is a discrepancy. I am using a lower depreciation. They are using a higher depreciation. If I use a lower depreciation, my profit before tax will be higher and logically the tax I pay will be higher. The income tax department is actually saying you don't need to pay so much tax. Because I have paid more tax today, that will create an asset for me. So it'll even out over the period because next year in this case I will get the tax benefit over 5 years. In this case I'll get the tax benefit over 2 years. After that the benefit goes away, right? So effectively in mathematical terms, it is just whether I'm paying more tax today or whether I'm paying more tax later. Based on that, there is going to be a discrepancy. In general, if we have accounted for higher tax today, we'll have to pay lower tax later. If we have accounted for lower tax today, we'll have to pay higher tax later. Deferred tax is a concept that comes on account of that. right? So that's something that that we have to keep in mind. It's a slightly more evolved concept. We don't need to worry about it too much at this point of time. But just in case this question arises in your mind as to what is deferred tax here, that's basically arising because of either the company paying more tax at this point of time or paying less tax at this point of time, and hence there is either an asset or a liability that gets created. When we look at the balance sheet discussions, we will realize that this item also comes and appears in the balance sheet on either the assets or liabilities side, right? That's when we'll probably explore this in a little bit more detail. For now, our understanding is that this is a little bit extra tax or lesser tax that you've paid, and an adjustment to the current tax is made on account of that. There's also another line item which says excess tax provision for earlier years. So in this case, for example, the company would probably have made some extra tax provision earlier years that was written back, right? So their tax amount goes down by this amount because they've already paid this tax earlier, right? Some provision they had made earlier. So these items could come in. Rest of it is all kind of self-explanatory. These exceptional items you see are typically going to be your non-recurring items, and you have to be a little bit careful about what these exceptional items are, right? So those are the other items in the P&L statement. Quick couple of questions as we kind of come to the end of this particular section. What do we mean by non-recurring items, and what do we mean by other operating revenue? Give examples of these.